Welcome to Finance Frontier, the podcast that brings you the most pivotal shifts and opportunities in the financial world. Today's episode is titled China's Bold Currency Gamble and Global Financial Repercussions, and we're here to break down the critical moves shaping the future of markets. Sophia and I are standing in front of one of the most iconic places in finance, the New York Stock Exchange, right here on Wall Street. You can feel the energy here, a place where markets are made, deals are struck, and fortunes rise and fall. The towering Corinthian columns and grand marble facade of the NYSE evoke a sense of reverence, as if it were a temple dedicated to global finance itself. We're standing at the epicenter of financial power, where decisions made in a second can ripple across the globe.
Absolutely. The New York Stock Exchange isn't just a building. It's a symbol of resilience, a monument to the relentless drive of the financial markets. Walking into the NYSE, you're immediately struck by the contrast between the historic architecture and the cutting-edge technology of today's market. The grand marble floors echo with the steps of traders, while the flashing screens and terminals reflect the speed at which global finance moves. When the opening bell rings, it signals the start of a new day filled with opportunity, but also with risk.
The NYSE has seen it all, from the crash of 1929 that sparked the Great Depression to the 2008 financial crisis, when markets teetered on the brink of collapse. Through it all, the exchange has remained at the heart of the financial world, a constant amid the chaos. It's seen times of boom and bust, and it stands as a reminder that while markets fluctuate, they always find a way to recover and grow. And today, as we stand before this historic landmark, we're here to discuss one of the most pressing stories in global finance, China's $100 billion short position against the US dollar.
Right. China's move against the US dollar is shaking up global markets, and it could have massive implications for the future of global trade and currency systems. But before we dive into that, let's take a broader look at what's happening in the markets today, including the volatility that's been sending shockwaves through Wall Street. And don't forget, we'll also be breaking down key strategies you can use to hedge against risks and seize opportunities in this fast-changing environment.
Before we get into the nitty-gritty, let's reflect on this thought. The stock market is filled with individuals who know the price of everything, but the value of nothing. Philip Fisher. Keep that in mind as we explore today's complex yet opportunity-filled environment.
Often, the greatest challenges in the market bring the biggest opportunities. So stay with us as we break down these global trends and give you the tools you need to stay ahead of the curve.
If you haven't already, be sure to subscribe to Finance Frontier, leave us a review, and share this episode with anyone looking to navigate the financial markets with confidence. Let's dive right into our top stories for today. Our first story focuses on China's bold financial move to short the US dollar by $100 billion using FX swaps. This strategy is designed to prop up the yuan, while hedge funds are reportedly seeing returns of up to 6%. Chinese banks are leveraging FX swaps to borrow dollars and lend yuan, avoiding the need to sell off their foreign reserves. This approach is creating immediate liquidity benefits, but it's also raising concerns about China's long-term ambitions and challenging US dollar hegemony.
That's right. FX swaps allow Chinese banks to maintain liquidity in their domestic currency without tapping into their foreign exchange reserves. But the risks are significant. If the yuan weakens, Chinese banks could face major losses. It's a high-stakes strategy that reflects China's growing role in global finance. As China continues to challenge the dollar's dominance, investors around the world are watching closely.
Our second story takes a look at the U.S. Treasury yields, which have surged to levels not seen since before the 2008 financial crisis. Rising interest rates are reshaping the bond market and putting pressure on businesses with high levels of debt. As yields rise, more investors are shifting away from equities into bonds, seeking safer investments. The question is, how will this impact the broader economy and the stock market?
With higher yields, financing costs for companies are going up, especially for those heavily leveraged. It's not just the bond market that's affected. Stock market bulls are feeling the pressure too. A surge in yields could signal caution ahead for equities, as investors recalibrate their risk exposure.
Our third story brings us to hedge funds. Hedge funds are continuing to reduce their exposure to equities, reflecting fears of an impending recession. Despite strong labor markets, hedge funds are positioning themselves defensively, bracing for an economic slowdown. This bearish sentiment could lead to broader sell-offs, adding more volatility to the market.
Hedge funds are often the first to make moves when they sense a change in market conditions. Their reduction in equity exposure is a signal to all investors to be cautious. We may see more volatility in the tech and consumer goods sectors as hedge funds scale back and adjust their portfolios.
And finally, let's not forget about the 2024 U.S. presidential election. Investors are closely watching how policy shifts might impact the markets. Sectors like tech and clean energy could be particularly vulnerable, depending on who wins. For example, a victory for Trump could undermine the Inflation Reduction Act, creating headwinds for green energy sectors.
That's right. Potential policy changes, especially around tariffs and inflationary measures, could lead to higher volatility in the U.S. stock and bond markets. Investors will need to be prepared for market swings as the election approaches, and the stakes couldn't be higher for sectors like tech, clean energy, and industries relying on imports.
So there you have it. Those are our top stories in today's news roundup. Now, let's shift gears and explore how these developments are being discussed across social media platforms. Social media is buzzing with discussions on the latest market movements. From China's FX swaps to the U.S. Treasury yields, people are sharing their insights, and today we're going to break down some of the key conversations happening online.
Let's start with this tweet from Holger Skipitz, which has been gaining traction. Chinese banks have built a $100 billion short against the US dollar to prop up the yuan, and hedge funds are eager to get in on the trade. At the center of it all are FX swaps, which have become a key tool for state-run Chinese banks during periods of heavy selling pressure. This highlights the financial engineering China is using to support the yuan, while avoiding foreign reserve depletion. The tweet has sparked debates about whether China's strategy is sustainable in the long run.
Exactly. This move by China has investors on edge. Another tweet from @FinFrontier AI sums it up well. China's $100 billion short against the USD via FX swaps is propping up the yuan, while hedge funds cash in with 6% returns. But with Chinese banks facing $5 billion plus in potential losses, is this strategy sustainable? It's clear that there are mixed opinions on how long China can continue this aggressive stance without triggering broader market disruptions.
Shifting gears to the U.S. market, the recent spike in the VIX has been a hot topic across social media. A tweet from @FinFrontier AI reads, "The VIX surged from 15 to 22, breaking through key moving averages. This is a strong signal of rising volatility, and it could mean significant market swings ahead." Investors are turning to defensive sectors like utilities and healthcare to hedge against this volatility. With so much uncertainty in the market, people are looking for safer assets to weather the storm.
That's right. As investors react to the VIX spike, many are seeking out defensive strategies, including volatility-based ETFs and commodities like gold. A tweet from @FinFrontier AI says it best: volatility is back. Investors are seeking safety in defensive sectors, bonds, and commodities. Are you prepared for the turbulence ahead? The rise in market uncertainty is pushing investors to rethink their portfolios and consider how to protect against potential losses.
And let's not forget about the buzz around the upcoming U.S. election. A tweet from @FinFrontier AI highlights the potential impact. Trump's Elon-inspired Government Efficiency Commission could reshape federal spending. Targeting fraud and waste sounds great, but the real impact will depend on how deeply this audit affects core services and industries. The tweet has sparked discussions on which sectors might benefit from fewer regulations and which could face risks. With the election around the corner, it's clear that investors are bracing for potential policy shifts.
That's a key point. The intersection of politics and the markets is always a critical area to watch. Sectors like tech and clean energy are particularly vulnerable depending on election outcomes. We'll keep an eye on how these discussions evolve on social media and what that means for market trends.
Social media continues to be a vital tool for investors to gauge market sentiment in real time. Now that we've looked at some of the key online conversations, let's dive deeper into one of the most significant financial trends impacting the global economy today.
Now, let's dive deeper into one of the most significant financial trends that could reshape global trade and currency markets: China's $100 billion short position against the US dollar, using FX swaps to prop up the yuan. This complex strategy has left many in global finance wondering about the long-term consequences.
That's right. China's move to prop up the yuan through FX swaps is part of a broader strategy to maintain liquidity in its domestic currency without tapping into its foreign reserves. The use of FX swaps allows Chinese banks to borrow dollars and lend yuan in the short term, temporarily maintaining stability in their currency. However, this approach comes with risks. If the yuan weakens unexpectedly, the costs of these swaps could escalate, leading to potential losses for Chinese banks.
The key to understanding FX swaps is recognizing that they are essentially contracts where two parties exchange currencies at one point in time and reverse that transaction at a later date. By leveraging these swaps, China avoids having to sell off its foreign reserves. But this heavy reliance on FX swaps makes China more vulnerable to sudden external shocks, like a sharp rise in U.S. interest rates or a shift in global market sentiment.
Exactly. And this plays into China's broader ambitions to challenge the dominance of the US dollar as the world's reserve currency. By keeping the yuan stable through these swaps, China is signaling to its trade partners, particularly in regions like Southeast Asia and Africa, that it is serious about positioning the yuan as a global currency. However, if this strategy backfires, it could create major disruptions in global markets.
That's the crux of the matter. China's strategy is unprecedented on this scale and comes at a time when global markets are already dealing with significant volatility. The question many investors are asking is whether this gamble will pay off or lead to broader market instability. If it works, we could see a shift in global trade dynamics, with the US dollar losing some of its dominance. But if it fails, the ripple effects could be severe, potentially triggering a new wave of market volatility.
Investors are keeping a close watch on this situation. Some hedge funds are already taking advantage of China's strategy, seeing returns of up to 6% from these FX swaps. But with Chinese banks facing billions of dollars in potential losses, the sustainability of this approach is questionable. The global market is holding its breath to see how this plays out.
This deep dive highlights just how interconnected global markets are. A move by China can have ripple effects across the world, impacting everything from currency markets to global trade dynamics. Investors will need to keep a close eye on China's actions in the coming months as this situation continues to unfold.
Now that we've examined China's FX swaps in detail, let's shift our focus to another critical issue impacting global markets: the surge in U.S. Treasury yields.
Another major development that's shaping global markets is the surge in U.S. Treasury yields, which have hit levels not seen since before the 2008 financial crisis. This rise in yields is a sign that interest rates are continuing to climb, reshaping the bond market and impacting a wide range of investments.
Exactly. Higher yields on U.S. Treasuries mean that investors are increasingly viewing them as safer, more attractive options compared to equities. This could lead to a shift away from stocks, especially in sectors like tech and growth industries, and into bonds. It's a signal that investors are seeking stability amidst economic uncertainty and inflationary pressures.
And for businesses with high levels of debt, this surge in yields could spell trouble. Companies will face higher financing costs as borrowing becomes more expensive. This is especially concerning for industries that are highly leveraged, such as real estate and energy. Those businesses may find it harder to roll over their debt, which could lead to liquidity issues down the road.
We're also seeing broader implications for stock markets as investors reevaluate their portfolios. The higher yields make bonds a more appealing investment, which could pull capital out of the stock market. David Ross, a bond market strategist, noted that a surge in yields could signal caution for stock market bulls, and we're already seeing some of that shift happening.
For individual investors, the rise in U.S. Treasury yields offers both risks and opportunities. On the one hand, higher yields provide a more secure return compared to the volatility of equities. On the other hand, it might be time for investors to reassess their risk exposure and consider moving some of their assets into bonds, especially if they're looking for more predictable income streams.
One important thing to note is that this rise in Treasury yields also signals increased caution among investors, particularly as inflation remains elevated. For those with a higher risk tolerance, there may still be opportunities in equities, but the rising yields certainly warrant a more defensive approach in portfolio management.
So, whether you're invested in equities or bonds, the key takeaway is to keep an eye on interest rates and how they're affecting both markets. For businesses and investors alike, understanding these dynamics is crucial to navigating today's financial landscape.
With U.S. Treasury yields at their highest levels in over a decade, it's clear that the economic environment is shifting. Investors will need to be nimble, adapting their strategies as these trends continue to evolve.
Let's shift our focus now to hedge funds and their recent moves to reduce equity exposure. This action reflects rising fears of an economic slowdown or potential recession, even as some economic indicators, like the labor market, appear relatively stable.
That's right. Despite the resilience in the labor market, many hedge funds are positioning themselves defensively, reducing their exposure to riskier assets. A Citi analyst noted, hedge funds are preparing for an economic slowdown, and we're already seeing this play out in the markets.
What's particularly interesting is that this shift is happening despite upbeat labor market reports. Normally, strong employment figures would signal a more optimistic outlook for the economy, but hedge funds seem to be looking ahead, preparing for potential downturns in other areas of the economy, such as consumer spending or corporate earnings.
This shift has significant market implications. As hedge funds reduce their positions, we could see broader sell-offs in sectors like technology and consumer goods. These sectors, in particular, are more sensitive to changes in economic conditions. For individual investors, this might be a time to reassess portfolio risk and consider strategies to protect against potential market volatility.
It's also worth noting that this bearish sentiment from hedge funds could contribute to increased volatility in the market. When major institutional players move to sell, it can trigger broader market reactions, adding pressure on individual stocks and even entire sectors.
So, what should investors do in light of these developments? One approach is to focus on defensive sectors, such as healthcare and utilities, which tend to perform well during periods of economic uncertainty. Another option is to increase exposure to bonds, which we discussed earlier, as they provide a more stable return when equity markets are volatile.
For investors with a longer-term horizon, staying diversified and avoiding panic selling is crucial. While hedge funds might be moving out of equities, that doesn't mean every sector will suffer equally. Staying informed and maintaining a balanced portfolio will be key to navigating any potential downturns.
The bottom line here is that even though hedge funds are preparing for a slowdown, individual investors need to think about their own risk tolerance and long-term goals. Now is the time to review your portfolio and ensure it's aligned with your financial objectives, regardless of what institutional investors are doing.
Let's now discuss U.S. Treasury yields, which have surged to levels not seen since before the 2008 financial crisis. Rising interest rates are reshaping the bond market in profound ways, and this trend has significant implications for both equity and bond investors.
Absolutely. When Treasury yields rise, it often signals a shift in investor sentiment. Bonds become more attractive because they offer a higher return relative to equities, which can lead to a rotation out of stocks and into safer, higher-yielding bonds. This could be a game changer for investors seeking stability in today's volatile market.
David Ross, a bond market strategist, noted that this surge in yields could signal caution for stock market bulls. As yields rise, it places additional pressure on equities, particularly in sectors that are more interest rate sensitive, like technology and real estate. Companies with high levels of debt may face increased financing costs, which could hurt their earnings in the long run.
That's an important point. Rising interest rates can also affect corporate borrowers, especially those with substantial debt. Higher borrowing costs could squeeze margins, making it more difficult for companies to grow or reinvest in their businesses. This could particularly impact sectors like real estate and utilities, which traditionally rely on borrowing for large-scale investments.
From a broader perspective, this shift in Treasury yields might signal a more cautious approach to the stock market. Investors looking for safety are increasingly turning to bonds, which offer a more secure return in an inflationary environment. That said, it's crucial to consider the potential trade-offs, especially if inflation remains persistent.
For investors, the key takeaway is that rising Treasury yields represent both an opportunity and a challenge. On the one hand, bonds are now offering more attractive returns. On the other, rising interest rates can create headwinds for stocks, especially for sectors that rely heavily on borrowing. It's important to strike the right balance between equities and fixed income investments during times like these.
For those heavily invested in equities, now might be a good time to consider diversifying into bonds or other fixed income securities. Even though rising yields can be a warning sign for stocks, they offer a safer investment option with a guaranteed return, which is especially appealing in a high volatility market.
Ultimately, this is a time for investors to stay vigilant and informed. By understanding how rising Treasury yields impact different asset classes, you can make more informed decisions about your portfolio. Whether you're leaning toward bonds for safety or looking to stay in equities, staying diversified and flexible will be key to weathering the current market environment.
Let's now shift gears and dive into a segment that directly connects technology with the financial world, our Technology Spotlight. In today's episode, we'll be focusing on how AI is increasingly being used to predict and mitigate market volatility. As we've already discussed, market volatility is on the rise, whether it's due to geopolitical tension, economic indicators, or strategic moves by global players like China. AI is stepping in to provide new ways for investors and institutions to handle this uncertainty.
Exactly. AI algorithms are now being used to analyze vast amounts of market data in real time. These systems can identify patterns that humans might miss, patterns that often signal upcoming volatility in the market. Some of the most advanced hedge funds and institutional investors are using AI-powered models to gain an edge in market predictions, and many individual investors are starting to tap into this technology as well.
AI is not just about data analysis. It's also playing a role in trading automation, where systems execute trades based on these predictions faster than any human could react. For example, in recent volatility spikes, AI-powered systems were able to shift asset allocations and hedge portfolios before many human traders even noticed the market shift. This ability to respond almost instantaneously to market movements gives institutions using AI a significant advantage.
One of the most compelling aspects of AI is that it doesn't just learn from historical data. It evolves as new data becomes available. This means that AI is continually refining its models and predictions, becoming more accurate over time. The ability to adapt and improve is what's giving AI-driven strategies a powerful edge, especially in unpredictable markets like the ones we're facing today.
And this technology isn't limited to hedge funds. Platforms offering AI-based portfolio management tools are now available to everyday investors, making it easier to manage risk and potentially capitalize on market movements. We've seen a lot of innovation in this space, and it's helping investors stay agile during periods of increased volatility.
Of course, AI isn't a magic bullet. It comes with its own set of risks, and it's still important for investors to maintain a diversified portfolio and not rely solely on automated systems. However, integrating AI into your investment strategy can certainly provide an extra layer of insight and agility, especially when navigating uncertain times like these.
For investors looking to stay ahead in volatile markets, AI-powered tools and systems are becoming increasingly accessible. Whether you're managing a hedge fund or your own retirement account, using technology like this could be the key to navigating the complexities of today's financial landscape. As we move deeper into today's financial landscape, one major concern continues to dominate conversations: recession risks. With the ongoing uncertainty in global markets, rising inflation, and geopolitical tensions, many analysts are now sounding the alarm about a potential economic downturn. But how likely is a recession, and what can investors do to prepare?
One of the key indicators that economists watch is the yield curve inversion, which we've discussed in previous episodes. It's been inverted for over 700 days, marking a record. Historically, an inverted yield curve has been a reliable predictor of recessions, And while it doesn't guarantee one, it's a flashing signal that markets are preparing for a potential downturn.
Another factor to consider is the behavior of hedge funds. As mentioned earlier in this episode, hedge funds have been reducing their equity exposure in response to growing fears of a recession. Despite relatively positive labor market data, hedge funds seem to be positioning themselves for an economic slowdown. This is a sign that even some of the most experienced market participants are preparing for a downturn.
Exactly, and it's not just hedge funds. Broader market sentiment has also shifted toward a more cautious approach. We've seen increased interest in defensive assets like utilities and healthcare, sectors that tend to perform well during economic downturns. For individual investors, now might be the time to consider a more defensive strategy, shifting portfolios toward less risky assets.
Investors should also keep an eye on the Fed's policy decisions. If the Federal Reserve continues to raise interest rates in an attempt to combat inflation, it could tip the economy into a recession. On the other hand, if inflation starts to come under control, the Fed may decide to cut rates, which would help stabilize the economy and boost investor confidence. But for now, uncertainty remains high.
To prepare for the possibility of a recession, diversification is key. Investors should consider balancing their portfolios with a mix of defensive stocks, bonds, and even commodities like gold, which often perform well during times of economic uncertainty. As always, staying informed and agile will be crucial in navigating the challenges ahead.
That's a great point. For those looking to safeguard their investments, now might be the time to reassess risk management strategies and ensure that portfolios are positioned to weather any upcoming storms in the financial markets. While we can't predict the future, being proactive and prepared is always the best strategy. Now it's time for our listener Q&A, where we tackle some of the pressing questions sent in by our audience. Our first question comes from Jessica in Denver, Colorado. She asks, with all the recent volatility and the discussions around a potential recession, how should I be adjusting my portfolio to protect myself against market downturns?
Great question, Jessica. As we mentioned earlier in the episode, one of the most effective ways to protect your portfolio is through diversification. That means spreading your investments across a range of asset classes to minimize risk. For example, in times of uncertainty, defensive sectors like utilities and healthcare tend to perform better, as they provide essential services that are less impacted by economic downturns.
Right. Another key strategy to consider is increasing your exposure to bonds, particularly long-term government bonds. These tend to perform well during recessions, as interest rates typically fall, making bonds more attractive. You might also want to look into commodities like gold, which has historically been a safe haven during volatile periods.
And don't forget about the importance of reviewing your risk tolerance. If you're nearing retirement or simply want to reduce your risk, now might be the time to rebalance your portfolio and focus more on preserving capital rather than chasing high returns. This doesn't mean you have to completely abandon growth stocks, but it's about finding the right balance for your specific financial goals.
Exactly. The key is to stay proactive and make adjustments before the market makes them for you. A well-diversified portfolio can help protect against sudden market swings while still providing opportunities for growth in the long term. Thanks for your question, Jessica. Our next question comes from David in Miami, Florida. He asks, with interest rates still elevated and the Fed's uncertainty on future cuts, what sectors should I be focusing on for stability and growth?
That's another excellent question. With interest rates remaining high, sectors that rely on borrowing, such as real estate and consumer discretionary, may face challenges. However, defensive sectors like utilities, healthcare, and consumer staples tend to be more stable during periods of rising rates because their demand remains relatively constant regardless of economic conditions.
Additionally, sectors related to clean energy might see a boost if interest rates eventually come down. As we discussed earlier, the clean energy sector, which is capital intensive, could benefit significantly from a more favorable rate environment, especially with ongoing government support and investor interest in sustainability.
And don't overlook opportunities in technology and AI. While these sectors have been hit hard by rising rates, they still have significant long-term growth potential, particularly in areas like artificial intelligence and automation. If you're willing to handle a bit more risk, adding exposure to innovation-driven sectors could offer strong returns over time.
Absolutely. It's all about finding that balance between stability and growth and adjusting your strategy as the economic landscape evolves. Thanks, David, for sending in your question. We've covered a lot of ground today, from China's strategic financial maneuvers to the volatility in the markets and key insights for investors. It's a reminder of just how interconnected the global financial landscape is and how quickly conditions can shift.
That's right. We've seen that while there are risks on the horizon, there are also opportunities for those who stay informed and act strategically. Whether it's finding defensive positions or embracing long-term trends like clean energy and AI, it's important to remain agile and well-prepared.
Remember, the best defense in volatile markets is diversification and a well-rounded portfolio. Stay ahead by keeping an eye on trends, such as rate cuts and how they're impacting sectors like clean energy and tech. And don't forget the importance of hedging your risks during turbulent times.
We hope you found today's episode insightful and that it helps you navigate the complexities of today's markets with more confidence. If you haven't already, be sure to subscribe to Finance Frontier for more deep dives into the financial trends shaping our future.
And if you enjoyed this episode, please take a moment to leave us a review, share it with your network, and continue the conversation with us on social media. Your feedback helps us bring you the most relevant and valuable content every time.
As always, it's important to remember that everything we've discussed today is for informational purposes only. We encourage you to conduct your own research or consult a financial advisor before making any decisions.
Thanks for tuning in to Finance Frontier. We'll be back with more insights and strategies to help you navigate the financial world with confidence. Until next time, stay informed and stay ahead. As always, we want to remind you that the content shared in this episode is for informational purposes only and does not constitute financial advice. We've used reputable sources such as Google News, Investing.com, Reuters, and insights from Twitter for our discussions today. However, market conditions can change rapidly, and the information may become outdated. We strongly encourage you to do your own research or consult with a professional advisor before making any financial decisions.
That's right. Staying informed is key, and while we strive to bring you the most accurate and relevant information, it's important to stay proactive in your own financial journey. The markets are dynamic, and being prepared for any changes can make a big difference in your strategy.
The music you've heard throughout this episode is licensed under standard agreements. A special thanks to the artist Twin Musicom for the track Not Without the Rest, provided under the Creative Commons Attribution 4.0 license.
This episode of Finance Frontier is copyright 2024 by Finance Frontier AI. All rights reserved. Thank you for joining us today, and we'll see you next time with more insights and strategies to help you stay ahead in the financial world.